Okay guys, welcome back to the channel. So I'm sure currently a lot of you guys watching this have similarly read portfolios at the current moment. And there's a whole plethora of causes behind this, but the most immediate one is the Fed and the hint at a half-point interest rate rise in the near future, pivoting to be more hawkish. Now, the news of rising interest rates isn't shocking anybody because over the past couple months, it's been continuously priced in to equity prices. The issue we have today is that when the expectations need updating, so do the prices we put on assets. So that's the latest update with the market and why your portfolio might be in the red at the current moment. But if you're anything like me, you're getting really tired of all these freakouts in the market, and at this point, you just want to take advantage of it. And in my opinion, if you're on the younger side of the investment spectrum, that's most likely the stance you should have. After all, just because the market is being irrational and freaking out doesn't mean that you should be as well. In fact, if you possess the ability to go against the grain and do the opposite of what the market is doing, historically, that leads to greater returns. But before getting too deep into that, let's first take a look and see how often market sell-offs even happen. So I really like this chart right here because it shows you the S&P 500 annual returns and intra-year declines. So in 2010, for example, the S&P 500 ended up 15% in the green, but within that year, it was down about 15% at some point. Of course, we have the really bad years like 2020 and 2007 where we had massive intra-year declines, but even during good years like 2016 where the market went up double digits, people often forget that there was over a 10% decline during that year. Okay, so we established that market sell-offs are extremely common. It's not a rare thing to be concerned about. It's just that last year in 2021, we had, I think, one correction of like 5%, and that was it. So we are a little bit spoiled. So of course the question is, once we have a cool mind, how can we best take advantage of buying the dip? What indicators can we use to efficiently buy in at cheaper or undervalued points? Well, in terms of technical analysis, you can use tools like simple moving averages, and this shows you the average price, in this case, over the past 200 days. And again, we can see in 2021 how the market did nothing but go straight up, and that is a huge anomaly. But more recently, we did just dip below the 200-day moving average, which could indicate a good buying opportunity. We also have the fear and greed index, and right now there is a good amount of fear in the market. In fact, I just conducted my own research on this. I put a poll up on the channel a couple days ago. A lot of you guys voted, and these are the results. So clearly a lot of pessimism is in the market. And historically, this is the time to buy if you have confidence in the long-term outlook of the stock market. In fact, the number one way that I identify dips and good buying opportunities in the market is the VIX. And the reason why I like the VIX is because it's very simple, effective, and it gives you a physical value. But to explore this idea a little bit more, let's read some of this article. So back in 2020, the author of this paper published a research paper where they examined using the VIX as a buy-sell signal to see if and at what levels it might allow investors to generate above average returns over time. And the answer is yes, and the paper went on to win the NAIM Founders Award that year for outstanding investment research. The concept behind the paper is a variation of the traditional buy low, sell high idea. The VIX tends to spike during market declines and remain low during periods of calm rising markets. Our theory was if you invest when the VIX spikes, you're essentially buying low. If you hold and only sell when the VIX breaches a certain floor, you'll be selling high. It goes on to say the trend here is pretty clear. The higher the VIX is when you invest, the higher forward-looking returns you have. The greatest returns, not surprisingly, came from cyclical growth sectors. That's not to say that the old-fashioned buy and hold strategy is bad, but it says that there are opportunities to exploit the market if you're willing to swim against the tide and be a buyer when the herd is probably selling. So here's the juicy bit. It says, what's the ideal VIX level to begin buying? So our research indicated that the optimal returns, again historically at least, were achieved when the VIX moved above 33. On the other end, it's time to sell if the VIX moves below 12. And for reference, this is the VIX right now. It's currently sitting at 28.5 0.21. If we zoom in a little bit, we can see the most recent spike because of the Fed news, but also the volatility we saw back in the beginning of 2022 right here. And of course, if we overlay this on the S&P 500, we can see why this indicates great buying opportunities. So being that the VIX is currently 28, we're getting very close to the optimal level, which is 33 and above. And again, I'm a huge fan of this, not only because historically speaking, it's been extremely effective, but it puts a finite number and tells you exactly when you should be buying. Because market corrections happen all the time, but when you're in the middle of it, it can be very daunting. And having a super basic indicator like this that gives you an exact number can be extremely valuable. So when it comes to my portfolio, investing when the VIX is above around 30 is my plan. And that's why for the past couple of weeks, I shut off my auto reinvest my dividends, and they've been collecting here, waiting for the VIX to go above 30. And if things continue as we saw last week, hopefully Monday or Tuesday, I will have that opportunity. Now, regardless of this indicator, buying when the market is going down, it's always a tough thing to do in the moment, but having good high quality assets really help in times of fear. If you're confident in the quality of your picks and that they have a bright future, then investing in them as they go down in value is going to be a lot easier to do. And if you want my insights on what I think are some of the best dividend and income ETFs in the market, check out my last video where I went over this entire topic. But that's going to do it for this video. Hope you guys enjoyed. If you did and you're still watching, I appreciate you liking the video, subscribing to the channel, and I'll see you guys in the next one.